The Fed hasn't spoken yet, but the options market has already placed its bet. And here's the part that surprises people. It's usually a much smaller move than the financial headlines want you to believe. Before we go further, one thing up front. This is educational commentary. It is not personalized financial advice, and nothing here is a recommendation to buy or sell anything. What I want to do today is teach you to read the same signal the pros read. So the next Fed day feels less like a coin flip and more like a math problem. Let's start with why this matters right now. Every 6 to 8 weeks, the Federal Open Market Committee meets, and retail traders treat it like a lottery drawing. But the options market runs on probabilities, not vibes. Traders are constantly buying and selling contracts that only pay off if the market moves a certain amount by a certain date. Add all those bets together, and you get a number the crowd is willing to stand behind with real money. That number is far more honest than any pundit. Point 1. The expected move. This is the single most useful figure, and almost no beginner looks at it. The expected move is roughly what the options market thinks a stock or index will swing, up or down, by a specific expiration. You can approximate it from the at-the-money straddle, the price of buying both a call and a put at the current price. If SPY is at 500 and the at-the-money straddle expiring Fed week costs about $10, the market is pricing an expected move of roughly 2% in either direction. That's your one standard deviation range. Now here's the contrarian part. Most people assume Fed day means chaos, a 5% lurch, portfolios on fire. But historically, the actual realized move on decision day is often smaller than the fear implies. In many recent cycles, the S&P 500's one-day reaction landed inside a 1 to 1.5% band. The options market frequently prices in more uncertainty than actually shows up. That gap between what's priced and what happens is where disciplined traders live. Point 2. Implied volatility crush. In the days before the meeting, implied volatility, the demand for protection, tends to rise. Everyone wants insurance before the event. That inflates option prices. Then the announcement lands, uncertainty resolves, and implied volatility collapses almost instantly. Traders call this the vol crush. It means you can be completely right about direction and still lose money on a long option because the premium you overpaid deflates the moment the news is out. This one mechanic destroys more Fed day trades than any rate decision ever has. Let me make that concrete. Say you buy a call for $3 the afternoon before the meeting, betting on a dovish surprise. The Fed does sound dovish. The index ticks up 0.5%, and your call is now worth $2.40. You were right, and you still lost. Why? Because implied volatility fell from, say, 25 down to 18, and that drop drained the premium faster than the price gain added to it. The market already paid you for being right in advance by charging you more. Point 3. It's not the decision, it's the distance from consensus. By the time a meeting arrives, the rate decision itself is usually a near certainty. As of most recent cycles, tools like the CME Fed Watch, which infers probabilities from Fed funds futures, often show one outcome at 80 or 90% odds days ahead. So the actual quarter-point move or the hold is already baked into prices. Markets don't move on the decision. They move on the surprise, the gap between what was priced and what was delivered, especially in the projections and the press conference tone. This is why the dot plot and Jerome Powell's word choice matter more than the rate line itself. The market can shrug off a hike it fully expected and then convulse over a single sentence about future cuts. In several meetings over the past 2 years, the index barely flinched at the decision headline, then swung hard 30 minutes later during the Q&A. If you're trading the number and ignoring the narrative, you're trading yesterday's information. Point 4. Read the skew, not just the level. Volatility skew tells you which side the market is more afraid of. Around Fed events, put options, downside protection, often carry richer implied volatility than equivalent calls. That tells you the crowd is paying up to hedge a drop more than to chase a rally. It's a fear gauge with a direction attached. When that skew steepens sharply into a meeting, the market isn't predicting a crash. It's telling you where the pain is expected to hurt most and where positioning is crowded. Point 5. The term structure across expirations. Compare the implied volatility of options expiring this Friday versus a month out. Before a Fed meeting, you'll often see the front-week volatility spike above the later months, an inverted, humped curve centered on the event. That hump is the market literally pricing the event risk into a single day. After the announcement, the hump flattens. Learning to see that shape means you can tell, at a glance, how much of the current option price is pure event premium you'd be paying for. So what does a disciplined trader actually do with all this? First, they check the expected move before forming any opinion, so their targets are anchored to reality, not hope. Second, they respect the vol crush. If they trade the event with options at all, they favor structures that can profit from falling volatility, like defined risk spreads, rather than naked long calls that need a huge move just to break even. Third, they separate the decision from the surprise, and they size small, because Fed Day is exactly when overconfidence gets punished. And maybe the most disciplined move of all is the one nobody posts about, doing nothing. There is no rule that says you must have a position on Fed Day. Sometimes the highest probability play is to let the vol crush pass, let the dust settle, and trade the cleaner setup that appears afterward when the range is known and the premium is cheap again. Sitting out is a position too. Here's the honest summary. The options market isn't a crystal ball, but it is a live, money-weighted forecast, and it's telling you three things before every meeting: how big a move is expected, how much fear is being paid for, and which direction that fear leans. Read those and you stop reacting to headlines and start reading the actual scoreboard. If breakdowns like this help you trade with a process instead of adrenaline, subscribe. It's the best way to catch the next one before the meeting, not after. Trade the math, manage the risk, and protect your capital first.